Is HIMS a buy or a sell? Let's get started with the model. This is a mid-cap company, 5.8 billion market cap. They're trading at $27 a share, and they have 218 million shares outstanding. HIMS is an online platform with over 1 million subscribers. The company connects patients to licensed healthcare professionals in all 50 states. It sells products for sexual health, weight loss, hair regrowth, mental health, and skincare. It was founded in 2017 based in San Francisco, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 21 and 22, still pretty low revenue. Their first positive in 2023, 47 million. Pretty low margins, 5%. But revenue tripled, up 200% to 150 million. Margins more than doubled to 12%. That means they convert 12% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative up through 2023, their first positive in the trailing 12 months. 8% net profit margin. Revenue is a sales for the company, and that goes up each year. It nearly doubles from 21 to 22, up 65% into 2023, over 1.2 billion in the trailing 12 months. Really solid growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 6.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.8 billion. We divide that by 218 million shares. And we get a calculated stock price of $27. They're trading at $27, so they're trading at a 1% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. If you put $10,000 into this company when they started trading in 2019, at one point you would have been at $23,000. Then you would have been down nearly 50%. But the stock has come roaring back. That $10,000 will be $27,000 today. You'd have a 21% annual return. To summarize, I have them trading at a 1% discount. I give them a ranking of 6 out of 10. I think it's a little risky in the short term because the stock has come up so much in the past year. Long term, I think it's a better investment, 6 out of 10. Ratios are a bit inflated, so 2 out of 10. Financials look really good. Revenue grows every single year, up 357% since 2021. And they went from negative free cash flow to positive. So financials, 8 out of 10. Let's take a look at their income statement. Revenue grew a lot, 227 million to 402 million. Let's see if they tell us what the revenue is. Of the 402 million of revenue, 390 million is online revenue, 9 million wholesale revenue. The online revenue grew 79%, wholesale grew 28%. So total growth of 77%. Their subscriber base grew 44% from 1.4 million to over 2 million. The monthly average revenue per sub grew 24% from $54 to $67. For almost a year, I bought the spray for my hair to help my hair grow back, but I don't think it worked, and it made my scalp really dry, really flaky. I ended up getting a hair transplant, and that worked. Their total orders for the quarter, 2.7 million. It looks like each sub orders a little less than 1.5 products each. I think I got a delivery every month for nearly a year. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue. That was 84 million. Cost of revenue is up 112%. So it grew a lot more than revenue. So their margins went down. So their gross profit margin went up 70%, since cost of revenue grew more than revenue. This income statement is just percentages. Gross profit margin last year, 83%. This year, 79%. Their biggest operating expense is marketing, 180 million. That's up 57%. Operations and support, 48 million, up 50%. Technology, 21 million, up 72%, and general and administrative, 45 million, up 24%. Operating expenses, 295 million, which is up 51% from last year. So their operating expenses didn't grow as much as their revenue. That's why they have positive operating income, positive 22 million. Last year, they had operating loss of 9 million. Their operating margin is 6%, so they convert 6% of their revenue to operating profit. The other 94% is expenses. 73% for operating expenses, 21% for cost of revenue. 73 plus 21 is 94. They had a big income tax benefit of $52 million, so net income $76 million. They talk about their income taxes down here. An income tax benefit of $52 million for the 3 months ending 9/30/2024. And this was due to the release of $60.8 million of their valuation allowance on their domestic deferred tax assets. Because a deferred tax asset will help you pay lower taxes or get a tax credit, as in this case. A deferred tax liability will result in higher taxes. You carry a deferred tax asset and deferred tax liability on the balance sheet. So they were carrying this asset for several quarters probably, and they're finally using it now this quarter. And their shares outstanding last year were 210 million. Now it's 217 million. So they added about 6.5 million shares. Let's look at a balance sheet. Current assets, 326 million. Current liabilities, 152 million. So their current ratio is above 2. They have over 250 million of cash and short-term investments. They do give a breakdown of the 89 million of short-term investments. I'll show you what that is. 59 million of US T-bills, 27 million of corporate bonds, and 2.9 million of government and government agency securities. Pretty low risk, low yield investments. They have 49 million of inventory. They always have a lot of inventory on hand. 28 million is finished goods. 28 million of finished goods, 21 million of raw materials. So finished goods you could sell, raw materials need to be worked on before you can sell it. They have 23 million of prepaid expenses. A prepaid expense is when you make an advance payment for a product or service you're going to receive in the future. They do give a breakdown right here. 13 million of prepaid expenses, 4.6 million of wholesale trade receivables, and 5.7 million of other. So not that much more information. Then they show 856,000 of restricted cash. They have a lot of goodwill, 113 million of goodwill. Goodwill is the premium you pay when you acquire another company. 52 million of PP&E. Here's a breakdown of the PP&E, 31 million of internal use software and website development, 25 million of facility equipment, 10 million of leasehold improvements, and 6 million of assets not placed in service. So the gross value is 72 million. They depreciate 20 million. So the book value is 52 million. That's the value in the balance sheet. They show 45 million of intangible assets. They do give a breakdown of the 45 million. 28 million is a 503B pharmacy license. If you have a 503B license, that means you can manufacture large quantities of medication without having patient prescriptions. So that's why they're able to sell so much product, because of this license. And they acquired 16 million of trade names. Intangible assets are amortized. Here's the amortization schedule. 1.4 million in 2024, 5.5 million next year, then 5 million, 5 million, 5 million. And the remaining 22 million will be amortized in 2029 or after that. Then you have operating lease right of use assets. These are assets that are owned by another company that they lease. And 54 million of deferred tax assets. We talked about that earlier. So their total assets, 600 million. Last year, 440 million. Total liabilities, 162 million. They have 75 million of accounts payable. This is how much money they owe other companies when they buy stuff. 43 million of accrued liabilities. This is when a company incurs an expense but hasn't paid it yet. Here's a breakdown of the accrued liabilities. 18 million in marketing. 11 million in payroll, 7 million of professional services, 3 million of taxes, 4.5 million of other. Say they're in contract with a company and the company provides them marketing, but they don't pay to the end of the year. So they're accruing these expenses, but they haven't actually paid it yet. At the end of the year, when they figure out how well the marketing did, maybe that's when they pay them. Deferred revenue, 32 million. This is when they receive payment for a product or service before it's provided. They owe 1.8 million of operating lease liabilities. This is owed within 12 months. And they owe another 9.5 million of operating lease liabilities beyond 12 months. They raised 708 million from selling their business, selling stock. And they lost 268 million from running their business. Accumulated deficit is a sum of all their prior net incomes. Their accumulated deficit at the end of 2023 was 368 million. They had a net profit in the first quarter of $11 million, so accumulated deficit improved to $357 million. In the second quarter, net profit of $13 million. Their deficit improved again to $344 million. And then they had net income of $76 million this quarter. So their accumulated deficit is down to $268 million. The $75.5 million is in net income on their income statement. I'll show you right here. It's right here, net income of $75.5 million. Let's look at their statement of cash flows. This is the trailing 9 months. So operating cash flow starts with net income of $100 million. Then we add or subtract the non-cash items on the income statement. That gain of $54 million for deferred tax assets, we minus that out here. That's a non-cash item. They had a cash outflow of $26 million in inventory, so that's a negative. That brings down their operating cash flow. So for the trailing 9 months, they had $165 million of operating cash flow. Last year, $52 million. They spent $17 million in CapEx. Last year, $8.6 million. So the way they calculate free cash flow, they take their operating cash flow minus CapEx, $17 million, also minus the investment in website development and internal use software of $8.7 million. I'll show you their free cash flow calculation right here. It's operating cash flow minus the $17 million minus the $8.7 million. So free cash flow, $138 million. A lot higher than last year, $36 million. They also spent $15 million of cash on acquisitions. So in their financing section, they had a cash inflow of $19 million. That's from the exercise of stock options. They pay $33 million in taxes. Those are taxes related to the equity awards, the stock-based compensation for their employees. They bought back $78 million of common stock, and they received $1.6 million from their employees from purchasing stock. Let's look at the company on Simply Wall Street. Its last price, 27, $6.2 billion market cap, up 1% in the past week. Look at this, up nearly 200% in the past year. This stock is a SPAC. You can tell because the stock price was $10 for several months. A SPAC is a shell of a company. It has no operations. Its only purpose is to acquire a private company. So they raise money through an IPO, then they go out and try to find a private company to make them public, since a SPAC is a publicly traded shell of a company. So at their IPO, they have no business operations or even a stated target acquisition. They're absolutely nothing. They almost always start out at $10 per share. So if you see $10 flat for several months or a year, you can almost guarantee that's a SPAC. A wide group of investors invest in a SPAC, from private equity funds to celebrities to the general public. A SPAC has 2 years to complete an acquisition. If they don't, then they have to return the money to the shareholders. So it looks like they IPO'd in October 2019, and it took about a year to find this company, because that's when the stock price started going up. Have you ever heard of a SPAC that took 2 years and couldn't find an acquisition target and had to return the money to the shareholders? I have not. When the company announces an acquisition target, usually there's a lot of buying and the stock price goes up. And then there's a big sell-off. Sometimes a SPAC gets down to $1, $2. This got down to $3.47 at its low. I wasn't sure if the stock would ever rebound, but it did really well this year. It was under its $10 IPO price in January. It reached its all-time high this month at 33. It has come down a little bit since the high, but still trading a lot higher than its IPO price. Simply Wall Street's valuation is 65. They say the stock is 59% undervalued. 13 analysts priced this stock at 25. They say it's overvalued. They only had $26 million of revenue in 2018, but it's been going up a lot each year. The following year it went to $83 million, then $149 million. That was in 2020. 2021, $270 million. 2022, $526 million. 2023, $870 million, and $1.2 billion in the trailing 12 months. They are growing organically, but most of the growth is through acquisition. Before they were acquired by the SPAC, they did have debt, $8 million. Once they were acquired, they got an injection of cash, and they paid off all the debt, and they've been debt-free since 2021. And you can see their equity goes up each year. Equity, $440 million. They have a lot of cash, over $250 million. The CEO's salary went from $250,000 to $600,000. Total compensation, $14 million. 10-year CEO, 8 years. In the past year, there's been a couple of insider buys, a lot more sells. Ex-Yankee pitcher David Wells. 70% of the companies owned by institutions, 17% by the general public, and 13% by insiders. BlackRock is the biggest shareholder at 14%. The CEO, 8.5%. Wellington, 1.5%. Bit Capital, 1%. And last on the list is Marshall Wace. Their employee count has gone up a ton from 131 to 1,000. The ticker trades on the Deutsche Börse, New York Stock Exchange, and Mexican Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.